G'day and welcome to the Grow a Small Business Podcast. I'm your host, Troy Trewin. Each week, we speak with an owner who has grown a business with 5 to 30 team members to something bigger. Diving into their numbers and unearthing the pain they've experienced, we explore what they did to overcome each barrier and what they would do differently from day one. Let's get into it.
Welcome everyone. I'm Mick Denehey, hosting today's Quick Fire Friday, and today I'm interviewing Troy, the founder of Grow a Small Business, who is based in Hobart in lovely Tasmania. And today we're going to be discussing tips for raising capital, which is a very common theme in business and a very important one for small business. So thanks for your time, Troy.
Thanks, Mick. Great to have you on as well. It's weird being on the other side of the mic, I must say.
Yes, well, that's flipping it over, isn't it?
Yeah.
So how do we know each other?
Well, I think we met 3 or 4 years ago through Rob, who's now also involved with Grow a Small Business with yourself. I met Rob probably 10 or 12 years ago, and through, because you work with Rob, that's how we met, I think, over a beer at one of the meetups.
It was, yes, and it's our relationships has developed from there, which has been great. Now, so tell our audience a bit about you and your experience on this topic.
Yeah, well, capital raising is a hot topic at the moment. I sit on 5 boards at the moment. I chair most of those boards, and nearly all of those companies are raising capital at the moment to expand their businesses. And there's 3 or 4 other businesses that I'm helping with capital raising as well. So it's been a really pertinent topic for me this year in 2022. So I thought it might be good to share with the audience. Yeah,
that's awesome. So yes, as far as when should a business owner consider raising capital?
Ideally when they don't need it. Don't be desperate. I've seen that happen, and because capital raising takes a lot longer than what people think it will take. So you've got to give yourself the time and have enough runway in your cash flow so you don't run out of cash. So that's the first bit of advice I'd give. Most small businesses, as you'd know, Mick, go under because of cash flow. They may be profitable, but they run out of cash. So you've really got to make sure you keep an eye on you really got to make sure you keep an eye on your cash. And another point I give to people is that I believe you should be selling equity last. You should look at leveraging debt and other sources of capital, which we're going to run through in a minute. That doesn't see you selling off some of the company. You especially want to maintain control, so at least 50% or 51% of the business as long as you can. So if you know your cash position and your profitability moving forward, you shouldn't be getting yourself into a position where you're desperate to have to sell equity to keep the business afloat.
Yeah, some good points there, and I think particularly that one, raising capital when you're not desperate, because particularly if you're going to a bank,
if they can smell it before you walk in the door.
Absolutely, and obviously if you're showing them financial information that indicates things aren't going so well, then it's even more challenging. And the other point about being profitable yet running out of cash sounds counterintuitive, but again, at the end of the day, cash is king, and many small businesses don't necessarily get that and don't manage that and don't do cash flow forecasts. So some really good points there.
Yeah, what do they say? Sales are vanity, profit is sanity, and cash is reality.
Yeah, very true. So what are some sources where small business can raise capital?
Well, I've broken it down into 4 areas. Working capital, money from the government, using debt, and then finally equity. So I just want to step through a few of those options there. We'll start with working capital, and that is looking at your business to free up more cash and profitability to find the funds to help you grow. So that may be launching a new product that is more profitable. It could be reducing your accounts receivable terms so your customers pay you sooner, and conversely, your accounts payable, you pay your suppliers longer. So you can have a look at some of those mechanisms. And also, as you would well know, Mick, the controls around debt chasing. So accounts receivable, a lot of businesses don't have good procedures, controls, and management around that. So you could have cash sitting there. And also pricing is a big one, especially in this day at the moment with the inflation rampant around the world. to be looking at the market and see what price will your customers bear, and do some testing and research on that. And I've got a podcast I'll advise at the end of this that people should listen to on pricing. And cost control is another big one. Reviewing your cost structure, whether it's your overheads or your cost of goods sold, and keeping a handle on those. That's one way to free up some more capital, so some cash to help grow the business. The next one, which a lot of businesses don't look into, I think for two reasons. One, it seems like a big barrier, and two, the governments are shit at marketing their products, which are grants and loans. People are surprised on the podcast when I ask them, particularly about if they know this Australian federal government loan called the Export Finance Loan. No one's ever heard of it. A lot of people have heard of EMDG, which is the Export Marketing Development Grant, but there's a slew of other grants out there that business owners just don't know of. The Entrepreneurs Grant is another one here in Australia. That's a $20,000 grant that you can get. You're entitled to. It's not competitive. You just need to be doing over $1.5 million, unless you're in a regional area, then it's half that in annual revenue. And you can get that $20,000 grant matched. So you have to put in another 20 to help grow your business in some way. So the governments around the world are generally terrible at getting this information out there in front of business owners. So there are two sources there, grants and loans, both loans at your state level as well. Here in Tasmania, we have a great support, a $60 million loan pot that's here that I've helped a few businesses apply for loans there. And they're very supportive, low interest rates. You don't start repaying it for a few years. And if the bank can't lend you money to help you grow, then often a lot of your state governments do have loan schemes like this. The next one's debt. So bank debt, just getting a traditional business loan from your bank, you will have to, more than likely, if it's over 50 grand, have to put up some property as security. And directors don't often know this, but they'll have to also sign personal guarantees. So if the business goes under, the banks can come after you personally. Another great option is asset financing. If you've got a business that's got assets, like, for example, the brewery I chair down here, we've got a lot of equipment, and we asset finance that. And interest rates are pretty good at the moment, around 9 or 10% per annum. And that's better than selling off equity. Again, personal guarantees may be applied to that. If you've got a good business finance advisor or broker, they can help you potentially get through that. Another debt option that's coming up at the moment is what are called revenue lenders. So big payment gateways like Stripe, PayPal, and Square are offering small businesses short-term loans. If it's under $70,000, usually you don't have to put any security up. And it's different to a traditional loan because you can put the amount in you want to lend. You can say, you might say 10% of the future sales, and it might take 3 or 4 months to repay that $70,000 because you might do $700,000 in sales over the next 3 months, and the revenue lender will take 10% of those future sales to pay back that money. Interest rates, what I've seen around that, are pretty healthy at 4 to 7% at the moment. You've got to put an application in online. There's a good one out there called Wayfly from Ireland that has just launched in Australia as well. I know they're in the US as well. And clear.co is another big one. They often tend to work only with online businesses, but if you've got a payments gateway like a restaurant, one of the businesses I deal with, I sit on the board of here, we just opened a restaurant late last year. We used Square, and we were able to get a $50,000 loan, I believe, through Square, even though it was for restaurant taking. So it's worth looking into. The revenue lenders will hook into your payment gateway, whether it's Stripe or PayPal, if it's not them that you're going through, that you're lending from. And they will also want to look at your Facebook ads if you're an e-commerce business to see how healthy your Facebook spending, ads and conversion, etc. are. But it's a pretty quick application online. A couple of businesses I've spoken with recently are trying that out. So that's definitely one to look into, revenue lenders. And most of the big payment gateways do have small business loans. Now, the fourth area that I really want to dive into, Mick, is equity, as you would have a lot of experience in as well. And there are a few areas here that I like to talk about. The 3 Fs, friends, family, and fools. Professional investors, employee share ownership plans, convertible notes, crowdfunding, and we'll go through each of those right now. The 3 Fs are either selling equity to your friends and family, people in your network, or even getting a short-term loan from them. So we definitely advise, if you are going to go down that path, and I'm currently helping one distilling business with that option at the moment, make sure you still go through all the legal proceedings you need. Have a good shareholders agreement, or if it's a loan, a good loan in place. Make sure everyone's very clear on the terms. I've seen many relationships busted because of this option going wrong. Professional investors, there are people out there that can help you find people that invest in businesses, and they will often take about a 5% cut if they bring an investor to you that invests in your business. So there are people out there you can look for. ESOPs, or employee share ownership plans. I might throw that over to you, Mick. You've done a few of these here in Tasmania. Just to quickly tell the audience a bit about what ESOPs are.
Yeah, thanks, Troy. Yeah, ESOPs becoming more and more common, particularly as a business called Succession Plus, who I'm involved with, have got a really good option in this context. So employee share plans basically allow you to have key employees, or even all your employees, have equity via an employee share plan. So you don't lose control. And one of the advantages of employee share plans is it's a reward-based approach. So, a profit share arrangement is not uncommon, and you provide the cash after tax. In this case, you're providing equity if you hit targets. And there's other ways, people can buy in via the ESOPs as well, but it's a great little way of bringing your people into the fold as far as equity, and it's been, I think, seen as, in particularly these times, a great retention vehicle.
Also recruitment as well. So it can help you land A players, but also save some of that cash. That's what we're talking about today, because if you say to the A player, come and work for the business, but we want to pay you 100 grand, not the 150 that the market, or you could get elsewhere, but we want to put that other 50 into, the share plan.
Absolutely.
Next one's there, a convertible note. So this is often a good one, so both parties can see each other. If an investor wants to see if you do what you say you're going to do and hit your numbers, they can lend you money, say, for 2 years at an interest rate, let's, for argument's sake, say 10%. And at the end of those 2 years, they can either choose to take their money back and you have to pay them the original loan plus the interest back, or they can convert that loan, that convertible note, into equity at a valuation agreed before the loan started. So it's a good way for both parties to see if they want to do business with each other. You can also structure the convertible note so the business can pay out the loan before the lender converts to equity. There's a few ways you can do it. Just talk to a good lawyer on that. Crowdfunding is a big one in the last few years. I think in New Zealand, the laws changed 5 or 6 years ago, so you could do crowdfunding. Australia was about 4 years ago, and it's quite a big market at the moment. Some of the benefits of crowdfunding is the equity is quite cheap. Valuations are often, nearly always, on a multiple of sales, and anywhere from 5 to 10 times. I've seen some as high as 20 times in the US at the moment. Current year sales. So that's a huge valuation. You also get a new sales channel. So those shareholders will be buying your products or services as well, and brand ambassadors out there on the market. So it's smart equity in that sense. You're getting more than just the cash. The misconception I've seen is that there's a lot of noise. You're picking up a lot of shareholders. And from my experience in speaking with 10 or 15 other businesses that have crowdfunded, the shareholders aren't noisy at all. If you just send them a quarterly newsletter, they're fine. So that's another great option. And I'll just close out the equity on a couple of tips around this. Again, what I said before is shareholders agreement. If you don't have one, get it now. Good corporate governance also helps. Speaking with Tom McMeekin, who you and I both worked with here in Hobart, he's a business finance advisor. He's helped a few of our businesses, restructure their capital, get debt, etc. And one comment he made on one of the businesses was the corporate governance we had in place. 3 independent directors on that board, shareholders weren't on the board. And he said the banks look at that in a very favourable manner when they're looking at lending, because there's good controls there. Shareholders are away from the key decisions. The 3 independents, we all have our arse on the line. We're on the ASIC register. So if the business goes under, we could go to jail. that shows the bank or the lender that there are responsible people that know the implications of fucking things up, basically. So he says things like that, a good corporate structure does help. Who's on your board, how big your board is, etc., and whether you've got independence on the board. Do your homework and get advice on what a reasonable valuation is when it comes to equity to help grow your business. If you need to sell some equity, your financial model and assumptions should be realistic, not pessimistic or optimistic. Otherwise, one party loses out. So you've got to, as we'll touch on in a minute, have a 10-year forecast. I advise a 5 or 10-year forecast. And then make sure you speak with an expert that is good at valuing businesses to give you an idea on what value you place on that business before you talk to potential investors about coming in and giving you cash and you giving them shares. And one final point, beware of heading into a down round. So that is, if I raise money at a $2 million valuation and then 6 months later or a year later, the business hasn't gone so well and we need to raise more money, but the new investors coming in don't value it at even $2 million, and that you have to raise that at a $1.5 million valuation. The first round of investors obviously going to be quite pissed off and a lot of noise and really unhappy with their investment. If you have to, again, if you're desperate and you have to raise money at a lower valuation, that's called a down round, which is a very, very nasty thing to have to go through.
Do you love talking small business growth with other owners? We have a vibrant online community from many industries around the world. Plus, we regularly add new tools and resources for community members and host 2 webinars a month to help you grow your small business. growsmallbusiness.com.
Fantastic. Some great insights and some tips there, Troy. And I think just rounding that out, I would suggest strongly that you seek external expertise with all of this. Small business owners don't necessarily do this regularly, so seek someone like you mentioned, Tom McMeekin, as a finance advisor. So rather than stuff around and waste time and energy, seek external assistance, and it'll just ramp up the process and get that funding quicker. So how about some main tips for considering for why you would consider raising capital, Troy?
Well, the first thing I say to people is get your shit in one sock. That means to be organised and live by the 7 Ps, prior, preparation and planning, prevents piss poor performance. So be organised. All sources except working capital will need some information presented professionally, and that includes a pitch deck. So that can just be a well-designed slideshow that is PDF'd. But I do recommend you have a graphic designer make it look pretty, because that has an impact on the lenders or the investors. And very importantly is a financial model. As I said, a 5 or 10-year forecast out. That does take some time to put that together, but it needs to be robust. We've raised money with a few businesses now that have no revenue, and they've either raised money from a lender or investors. One business in particular, we recently raised $500,000 on around a $2 million valuation with no sales, no equipment yet. And all we had was the pitch deck and a 10-year financial model, and we were able to convince 6 or so investors to come in to raise that $500,000. So it can be done. I've seen it. It's all about being well organised and having that, particularly having that financial model. And the pitch deck should have a few slides summarising the financial model, including the key assumptions. You may not need a more detailed business plan. I've seen some have come to me with a 120-page business plan and no one reads it. And then we've just crystallised that down into the pitch deck, which is slides just with key points, every corner of the business and the plan of the growth.
Fantastic. I think with banks and lenders, they tend to be more after 3-way forecast these days, and what that means is a forecast on a profit and loss basis, on a cash flow basis, and a balance sheet forecast. So they're after a bit more complexity with some of the financial modelling.
And what's important in that is integrated. So if you change something in the profit and loss, your sales forecast changes, then cash flow will automatically change. So it has to be integrated.
Absolutely. So there's a bit of complexity in how it's set up, and that's where, again, using external experts is useful, but it's also a very useful tool for managing the business and doing some scenario plannings and so forth. So there's two good reasons for that. So just to close out, Troy, what is at least one thing you'd recommend a small business owner does on Monday, based on your knowledge and expertise in this area?
Firstly, work out if you need to raise capital, and if so, when. If it's in the next 6 months, you need to get your skates on and do these things right now. So write a nice pitch deck. You can just start that, open up a Google Doc and just start writing some headlines. There are some examples out there of how to structure it on the internet. Get a 5 or 10 year financial forecast created. So if you've got a strong finance person in-house, get them to start putting that together if you don't already have one, or ask your accountant, or get a special advisor that helps build those financial forecasts. Only write a detailed business plan if one of the sources requests it. Business owners can waste a lot of time just regurgitating and spewing into a document that no one's ever going to read, and it can be overwhelming. So we've raised money, as I said before, just off pitch decks. You don't need a 200-page or even a 50-page business plan. Talk with a good business finance advisor like Tom McMeekin that you and I have both worked with. They specialise in helping you restructure or access debt. And Mick, you've had some experience around this with Tom with a few businesses.
Yeah, absolutely. Tom's got a raft of experience, focuses with businesses only, but is as much strategic with respect to funding, and it's not a transaction. So he's a good person to be in your team, so to speak, to help grow your business and make sure your funding is appropriate.
And a final few tips: practice your pitching, even watch some Dragon's Den or Shark Tank episodes. Pitch in front of someone who'll give you frank feedback and coaching and has the experience in this area. Sign up to local, state and federal government newsletters to be notified of grants, and or put a reminder in your calendar for at least once a month to look through grant websites. Some grants are only open for 4 weeks. Listen to episode 44 I did with Christoph Petzold from Simon & Kucher, the world's leading pricing experts. Also, episode 124 with Alan Miltz from Cashflow Story. He has some great advice there, and their material is relevant for boosting cash flows from your operations. You and Rob have both implemented a lot of ESOPs, and I've had Craig, the founder of Succession Plus, you mentioned, on the cast, episode 55. Definitely have a listen to that. And finally, if anyone's considering doing a crowd fund, just email me, troy@growasmallbusiness.com, and I'll send through a folder of investment memorandums I keep from those past crowd funds. And there's a summary sheet in there as well. We have almost 200 IMs, investment memorandums, saved in that folder and in that summary sheet. If anyone's seriously considering crowdfunding, more than happy to have a chat, see if I can help, give some advice, and at least have a look at that folder.
Thanks, Troy. I think everyone should get a lot out of today's cast, and it's so very relevant for all small businesses out there, making sure they've got their funding arrangements in place. Thanks, mate.
Thank you.
And for our audience, we would greatly appreciate a review in iTunes or whatever platform you listen to us on. More reviews means we bubble up higher in iTunes, etc., so more business owners looking for podcast help with their growth will find us.